The $90 silver trap. Why they crushed metals to create $120 breakout silver just got destroyed. Down 829 to 76.225. After briefly touching 99 overnight, the exact level everyone was waiting for. This wasn't an accident. This wasn't market sentiment. This was the most brutal precious metals manipulation in years, designed to crush every retail investor who believed $90 was the breakout level. Gold swinging from above $5,000 to $4,930 in violent sell-offs that destroyed leveraged positions across the globe. Silver crashed 17% overnight after teasing up at 90, the psychological level that would have triggered massive FOMO buying from retail investors. Here's what Kitco isn't telling you about this crash. It was coordinated. Kevin Warsh gets nominated as Fed chair, a notorious hawk who wants to crush inflation through higher rates. Iran suddenly agrees to Friday negotiations with the U.S., collapsing oil prices and removing the war premium. The dollar rockets to a 2-week high. All on the same day silver touches $90. Coincidence? The largest precious metals sell-off in months happens exactly when silver hits the breakout level everyone was watching. This was a precision strike designed to burn the fingers of every dip buyer who thought 83 to 85 was the bottom. Let me show you the exact timeline of this manipulation. Silver touches $90 in Asian trading, the moment retail algorithms would start buying aggressively. Within hours, 3 bombshells hit simultaneously. Kevin Warsh nomination announced. The same Kevin Warsh who called for aggressive monetary tightening and criticized Powell's dovish policies. Wall Street knows Warsh means higher rates, stronger dollar, and crushed commodity prices. Iran's Foreign Minister Abbas Araghchi posts on social media that U.S. negotiations will happen Friday in Oman. Oil immediately collapses towards $68 Brent, $64 WTI. The geopolitical premium that was supporting metals evaporates overnight. Dollar index rockets to 2-week highs on upbeat economic data. But the same data was available yesterday, last week, last month. Why did dollar strength suddenly matter today? Because someone needed dollar power to crush metals at the exact moment silver hit $90. This level of coordination doesn't happen naturally. You don't get 3 major market-moving events on the same day. Silver touches critical resistance unless those events were timed to create maximum damage. The technical damage is devastating. Silver's bearish pennant pattern just confirmed with a breakdown below 80. Next support sits at this week as low of 71.20, then the psychological $70 level. Bears are in complete control with a Wyckoff rating of 5.0. But here's what technical analysis won't tell you. This breakdown was engineered. Look at the volume patterns. Massive selling pressure concentrated in a 4-hour window, followed by continued liquidation as stop losses triggered cascade selling. Gold's key reversal pattern from last week just got confirmed with today's $48 crash to $4,803. The bulls, who thought $4,900 was solid support, got annihilated. Next target for bears, $4,700, then the critical $4,123 level that would confirm this entire rally was a dead cat bounce. The long liquidation Kitco mentions isn't random profit-taking. It's forced selling from leveraged traders who got trapped believing the $90 silver breakout was real. Margin calls are cascading through futures markets as positions that looked profitable at $85 are now underwater at $76. Why the trap was necessary. Here's the part mainstream analysis won't tell you. This manipulation was necessary for the next leg up. Silver couldn't break out from $90 with weak hands holding positions from $83 to $87. The market makers needed to flush those positions before allowing the real move higher. Think about it logically. If silver had broken above $90 yesterday, retail FOMO would have driven prices to 100-plussers within days. But that move would have been built on speculative buying, not industrial demand. It would have collapsed just as quickly when profit-taking started. By crushing silver back to $76, the manipulators achieved several objectives. Liquidated all leveraged long positions, scared away momentum traders, and created buying opportunity for industrial users who need physical silver regardless of price. Tesla still needs silver for Cybertruck production. Apple still needs silver for iPhone 16 manufacturing. Solar panel companies still need silver for spring installations. The manipulation doesn't change physical demand. It just provides better entry prices for smart money. The Iran factor, the Iran negotiations announcement, was the perfect cover for metals manipulation. By scheduling talks for Friday, Iran removed immediate war risk that was supporting oil and precious metals. But here's what the mainstream analysis misses. These negotiations are theater. Differing positions over parameters means nothing will get resolved Friday. The talks will either fail or produce meaningless agreements that don't address core issues. By Monday, oil prices will recover and metals will follow. Iran knows this. The U.S. knows this. But the announcement was enough to trigger algorithmic selling that crushed metals while smart money accumulated. It's the oldest manipulation trick. Use geopolitical headlines to move markets, then reverse when headlines fade. The risk premium that Bloomberg mentions getting reinserted into oil prices, that premium never actually disappeared. It just got temporarily suppressed to allow metals accumulation at lower prices. The Kevin Warsh deception. Kevin Warsh's Fed nomination is being portrayed as bearish for precious metals because he's hawkish on monetary policy. But here's the real analysis. Warsh can't actually do anything hawkish in the current economic environment. U.S. debt service costs are already consuming 25% of federal revenue at current rates. Raising rates further would trigger sovereign debt crisis that would force precious metals buying as dollar alternatives. Warsh knows this. His hawkish reputation is just theater to strengthen the dollar temporarily. The bond market already pricing in this reality with 10-year yields at 4.2%, levels that would normally crush metals. But industrial silver demand is so strong that even hawkish monetary policy can't overcome physical shortages. Warsh's nomination actually sets up the perfect precious metals scenario. Attempted tightening leads to economic crisis, which forces policy reversal and massive metals rally. The market makers are positioning for this outcome by accumulating metals at artificially suppressed prices. The accumulation opportunity. This crash to $76 silver creates the best buying opportunity since the March 2020 COVID lows. Every technical indicator screams oversold. Every fundamental factor supports higher prices. Every manipulation tactic has been deployed to create maximum pessimism. Smart money is loading up on this weakness. While retail investors panic about $70 support breaking, industrial buyers are securing supply for Q2 production schedules. While futures traders liquidate losing positions, physical dealers are seeing unprecedented demand. The bearish pennant breakdown that terrifies technical analysts actually creates mathematical buying opportunity. Silver at $76 is 15% below industrial cost curves. Mining companies can't survive at these prices long term, guaranteeing supply reductions that will force prices higher. The $120 silver timeline. Here's why this manipulation sets up $120 silver within 8 to 10 weeks. Iran negotiations fail by Monday. Oil recovers. Geopolitical premium returns. Warsh nomination gets Senate pushback. Hawkish expectations moderate. Dollar strength fades as economic data deteriorates. But most importantly, physical silver demand never stopped. The manipulation cleared out speculative positions, but couldn't reduce industrial demand. With weak hands gone and leveraged positions liquidated, the next move up faces zero resistance until $100, then clear air to $120. Technical support at $70 becomes launching pad for the most explosive silver rally in decades. The same patterns that looked bearish during the breakdown become bullish continuation signals during the recovery. What you need to do now, this crash is gift from the manipulators to smart money. They needed to shake out weak hands before allowing the real breakout. Silver at $76 won't last. Industrial buying will absorb every ounce available at these levels. Don't fight the mathematics. Iran talks are theater. Warsh hawkishness is constrained by debt reality. Dollar strength is temporary counter-trend rally. Industrial silver demand is permanent structural shift. The 90 trap was designed to crush retail sentiment and create accumulation opportunity for institutions who understand the bigger picture. While retail panics about technical breakdowns, smart money prepares for the $120 breakout that's coming. Silver touched $90, crashed to $76, and created the setup for $120. The manipulation was brutal, but necessary. Now the real rally begins. Position accordingly.